5 crazy ways rich people use debt to make more money. Have you ever heard the saying, debt is the root of all evils, never accept it on, it's slavery? Well, to some extent, that is true because once you're in debt, your life is finished. Your debts are not waiting for you to pay them, rather they are accruing daily interest. There is always interest charged on loans since nobody lends money for free. Despite all of this, the United States has accepted that the average household now owes more than $5,300, bringing the total amount of consumer debt in the country to about $15 trillion. The US economy is made up entirely of the GDP, which is just over $21 trillion. I do, however, have some good news for you. Bad debt, which makes up the majority of our total debt, isn't always bad. You most likely have credit card debt, a vehicle loan, and possibly student loans. And you're probably thinking that it will take decades for you to pay off all of your debts. How in the world is it a good thing? Let's look at how those with deep wallets continue to use it to make even more money to better grasp how that might be something positive. It could sound a little perplexing because debts are meant to be utilized by those who lack money, so why would someone with a lot of money use them in the first place? However, that is not how capitalism works. If you know how to use it, it can be a really effective tool. You may learn how wealthy people use that to increase their income in this video. So click the thumbs up button and let's get started. Number 1. The majority of trade is debt-based. It may sound a little provocative because it is a terrible idea to borrow money to start a business, and I for one would never act in such a way. However, there are some industries, particularly traditional industries, where borrowing money is your best option. Consider selling pens as an example. Pens are a relatively common product and there is almost always a market for them. In an ideal world, you would take a plane to China and locate a plant that makes that kind of pen at a reasonable cost. You would buy a container of pens, send them to the United States, and give them to your customers. But these days, most of that is done online through platforms like Alibaba. The caveat is that you don't actually have to pay for the product to get it first, unless it's a more sophisticated product and you have to fly to that factory. Let me explain how China has transformed over the past 50 years into the world's factory, producing just about everything. In order to make it easier for their products to be sold, the majority of the thousands of factories that continuously manufacture everything the world needs would be happy to lend you their goods, in exchange for them expecting payment from you at a later date. Naturally, you will need to establish some level of confidence with them first, as they won't lend to complete strangers. But that's how business has been conducted for the previous 50 years. Once the product was sold in the United States or another country, the client would pay the producer and borrow more goods. In essence, you're telling the factory that you know how to make it, so let me help you market it. My profit will be whatever price I can get it for when I sell it. Selling is one of the greatest talents you can ever learn since it allows you to complete the transaction without using any of your own money. Number 2. Since real estate debt can be refinanced, it is the finest type of debt to have. You are paying more taxes if you don't have a mortgage. Rich folks always have several mortgages, so they may take advantage of all the deductions. Keep in mind that every dollar you avoid paying in taxes but make instead is an additional dollar. So that's another way wealthy people accumulate wealth. But allow me to tell you a more realistic method. This is essentially how wealthy individuals become wealthy in real estate. If you manage to save $200,000, it is a significant sum of money. However, if we're being completely honest, that's nothing. Not even a property can be purchased. Obviously, since a 20% down payment is required, you are not eligible for a mortgage up to $800,000. But here's the trick. Imagine you find a $500,000 piece of real estate that needs some, maybe a lot of renovation. It's in horrible shape. You go to a bank and pay a 20% down payment to obtain a mortgage. Let's assume your renovation budget is $50,000 or about 10% of the overall cost of the house. You visit your bank once more, only this time you want to refinance your mortgage. The worth of that home was only $50,000 when you obtained your first mortgage because no one wanted to live there due to its terrible condition. But now that you've renovated it, there are renters interested in renting it out. So let's suppose the property's market worth has increased to $700,000 for the first time. Let's say you're going to acquire an 80% mortgage. However, 80% of $700,000 is $560,000. You will need to give your first bank, which provided your first mortgage, $400,000 of that sum. After subtracting another $50,000 for refurbishment costs, you will have an additional profit of $100,000. You gained $100,000 with that, and you now own a home that you can rent out to increase your equity and produce passive income. Furthermore, since you have a mortgage, you will be exempt from paying taxes. Real estate investors frequently engage in this type of activity. After hearing this, can you honestly say that debt is bad? I'll let you respond to that in the comment section below. Number 3. Hedge money. Hedge funds are created by the wealthy for the wealthy to increase their wealth, and they typically employ unpopular techniques. Mortal people like you and I do our best to anticipate which firms will expand and increase in value, and we spend the money we have worked so hard to earn in the hopes that these companies will expand. However, hedge funds frequently employ a completely different tactic. They attempt to profit when businesses decline or go out of business, as was the case with GameStop. Nevertheless, in that instance, the internet put hedge funds to the test and caused them to lose almost $13 billion. However, how do hedge funds generate income from debt? Let's imagine you predict a particular stock would fall like Facebook because you know that the most popular smartphone manufacturer, Apple, will declare next week that it will no longer allow apps to track users. Like Facebook and Instagram, which track your online activities and prioritize privacy, this will seriously harm Facebook's revenue model. So you pick up the phone and dial your broker in order to borrow from him a single share of Facebook that costs, say, $100 and immediately sell it for $100 on the open market. Congratulations, you now have $100 in your wallet, but your broker still needs to be paid for one Facebook stock. In the event that you are correct and the price of Facebook stock drops to $70 the following week, you can use $100 to purchase one share at the lower price and then sell it back to your broker for the difference. Congratulations for making 30 from a full supply. Though it appears straightforward in theory, doing it well is quite hazardous and complicated. What occurs if you are mistaken? What if the cost increases by 50% tomorrow? You still need to pay interest for borrowing that one share of Facebook stock and return it to your broker. Now that stock must be purchased for $200 in order to give it back to your broker. The amount you invested is the most you can lose when you buy a stock and try to sell it when it increases, but not when you short it. If the cost increases, your losses also increase. Since the stock price might possibly increase eternally, you may theoretically incur a limitless amount of losses. However, if you employ 100 analysts, you can make a fortune employing this tactic. Number 4. The Forex. Here's how it works, but we already covered this in our Forex video, the link to which I'll give in the comments. A market where currencies are traded is known as the Forex. It enables cross-border commerce. China accepts US dollars. For instance, in China, you have to buy Chinese yuan in order to pay your staff. As a result, there's a market where anyone or any business can go to buy foreign currency, and these currencies change according to a variety of circumstances. For instance, if the Fed raises interest rates, this will reduce the amount of dollars available on the market and strengthen the dollar relative to other currencies, or vice versa. Therefore, you can earn a lot of money in this market if you can forecast which currencies will increase or decrease. However, what sets these markets apart from the rest is the ability to borrow an additional $100 for every dollar used to trade in currency. That implies that if you trade with your $1,000, you can have a position worth $100,000. It will be significant even if you only wind up making a tiny profit of 1%. Number 5. Credit score. Evidently, that is a strong tool. Every successful firm or entrepreneur makes use of that in a number of different ways, particularly if you have a tested business plan. Almost every firm uses financing purchase orders obtained from borrowing. Stop assuming that all debt is bad. Debts with a high interest rate such as credit card debts are undoubtedly terrible, but lowering the risks associated with lending you money will result in a reduced interest rate. Why do you do that? You establish a reputation for being a trustworthy borrower. There are hundreds of billions, if not trillions, of dollars in banks that are just waiting to be lent. Additionally, banks have the ability to produce money out of thin air, as we have already explained. Thank you for watching. If you thought this video was helpful, please consider subscribing to our channel and become a member of our fantastic community. We appreciate each and every one of you spending time with us today. Until next time.